here tonight. So anyway, so I guess, the appropriate thing to do to start our meeting is to offer a word of prayer. Can I get a volunteer for prayer? Sure, Judy, that'd be great.
Our Father in heaven, we're so thankful we can be here at our financial accounting class with Brother Fox. I pray that the Spirit can be with us as we continue to expand our minds and learn new concepts, and that we are so grateful for thy love for each and every one of us. And we see these things in the name of Jesus Christ. Amen.
Amen. Thank you. Let's see, I'm going to put... All right. So, like I said, welcome. I think it's an interesting thing. When I was going to school and studying accounting, I thought this is really and truly a purely secular area of study. It didn't feel very spiritual to me in any way, but it's an interesting thing. I've taught it for years now, and students, kind of regardless of their background, their religious beliefs, whatever, a lot of them, they'll have this moment. In this chapter, we're going to do a trial balance, and then you have the balance sheet sort of introduced to you, but there's this moment when everything flows together nicely, and the trial balance balances. And I see the students like get this little exhale, this little like moment of peace. And the same thing when the balance sheet, when the assets equal the liabilities plus equity. And you might just say they're relieved they got the problem done, but I really think that there is something about the order in accounting when it all balances and when everything is right. There's this moment where it's like you just touch a little bit of that sense of order that's just there, that's present all around us. And I know someone would probably laugh at this, but I do. I find that little moment of getting things just so, that balance, a wonderful thing. And after all, the Lord's creations and the Lord's universe and the Lord's kingdom is one of order. And so I think anytime we tap into something, I used to think you had to like find something like spiritual to talk about, like in these classes. And what I found is it works much better to recognize those things that are spiritual that are there, rather than like trying to come up with some profound thing to say. It just so I hope you feel that. I hope when your trial balance, you'll have this moment of like, yeah, everything's right in the universe, and then back to life, right? Because everything in my life doesn't perfectly balance. I have teenage kids. Anyway, and so I wanted to just start today by showing you, I mentioned last week, let's see. I mentioned last week, there's this, each week in the introduction, I put this link to the sort of some additional study materials that I put together. And it's kind of a growing thing since they changed the whole textbook and everything. I'm just sort of slowly piecing things together. But it's down here. So this is just in the weekly introduction. There's a little additional study content and there's a link. But I was going to show you, I also added that link in the modules. Right. All right, that's the instructor resources module. You wouldn't see that when you signed in. Right under textbook information, I just put Brother Fox's additional study materials. And so that's that same link. So if you click on it, it'll take you to, again, this is just this thing. I'm slowly putting it together by chapter. So what I've added this last week was a chapter 11 overview. I actually just took that right out of last week's meeting with us. I just clipped that part out where I gave a little, I guess you call it a lecture on the chapter 11 material. And then kind of as people reach out to me for help with some of these problems in the quiz access, if I record a little video for that, I'll just add it here. So just know, I mean, that's a place. And so if you do come here and you're like, that he doesn't have what I need, you can reach out and I'll record one for you. It depends on my schedule. Some days I can do it right away, and other days it might take me a day or two to be able to set aside the time to make a special one-off video. And then something else you'll probably be interested in is this right here, the exam review. So this is something that again, with this course moving to a new textbook, so the exam is different than it was in previous semesters. Several of the instructors of the course kind of got together and worked up this exam review and then got it approved. So this is in here. If you click on it, it's the PDF. You can print it if you like to read off of a printed paper. And this actually is a review for all of the exams in the course. And so it's broken down by chapter. Well, broken down by exam and then by chapter. And the way that they put this together, we keep being warned about putting together exam reviews that are, I guess, just pulled like directly from the exam questions. And instead the intent is to guide someone's study. When there's so much material, how do we guide your study so that you just can't memorize all of it? But I will say, this little, so they have it broken down into bullet points, which curiously do look like someone looked at the questions and pulled these bullet points. And then these critical reviews are things that you really need to know, okay? So I just want to show you that that's there. It's still a lot of material, right? For that first exam, you're still talking about 2.5 pages of bullet points, and it's not enough just to memorize those, but it's going to help guide your study anyway. So that's there as well. Just wanted to make you aware of that tool, and then just the overall tool of this page. All right, so any questions, I guess, of a general nature, not specific like homework problems, we'll get to those near the end, but questions about the course in general, the layout, or broadly about assignments or things like that?
Brother Fox, I actually have one that I ran into today. I went to go try to do the
Proctorio.
Yes. And I was like 30 minutes on there and they said it wouldn't work. So they wanted me to tell you it was an instructor side issue, I guess.
Well, yeah. So I just sent it. So I went back through the emails of our instructor group and with, you don't need to see my email, sorry. And was like, so, hey, what's the verdict here? Because when I pull it up, it also says, whatever it says, like set up not ready or something, contact instructor. And I'm like, well, I'm the instructor and I don't know anything about it. So what I can say is we're working on it. I know there's some issue with Proctorio not playing well with McGraw-Hill. And so I think they're working on that, and they're trying to decide if they're going to pull the quiz out of McGraw-Hill and just put it in Canvas, or so I believe that's what's hanging it up. But I did, because someone else emailed me about it today, and so I emailed the lead instructor who's kind of do this whole pilot of this new McGraw-Hill thing, and to try to find out what's going on. So short answer. The really short answer is I don't know yet, but I will let you know hopefully by tomorrow when I get a response.
Awesome. Just so you have some information, like I said, I was on there for about a half an hour with them going through different things. There should be, if you do pull it out on Canvas eventually, there should be a section under our modules when we go through that says Secure Exam Proctor within our Canvas, which we don't have right now. So they were a little surprised by that. But then also it says you can try it in both Edge and Chrome. They gave me a different link for both. So if one doesn't work, you can try the other one. They said it would work both ways. And then the guy I talked to just said, if you guys whoever's working with them, to contact them directly, and somebody will actually be able to help them pretty quick.
Okay. And I'll
at least that's what he gave me.
Right. No. So yeah, part of the challenge is that like accounting, there's like 20 sections of accounting with like 15 different instructors. And so there's like one lead instructor who's supposed to like, handle all that. And then like they push it out to all the courses. Otherwise, I think they would have a real hodgepodge, which it feels like they've had anyway. Although I will say in this, each week, I feel like they're ironing out some of those issues. It feels smoother this week, or more smoother. I don't know. Anyway, so yeah, so I will definitely tell him that you contacted I'm assuming it's like tech support at BYUI, and they were surprised that we didn't have this in order. So
I actually contacted the Procterio people, and they walked
Okay.
me through a bunch of different ways to try to set it up and ways to go around into a different direction to get it set up. And that's kind of what they were seeing
yeah,
based on
Yeah.
what we tried.
yeah. So I mean, so it sounds like consistent with what I know right now, which is it's on our end, not Proctorio's end, and we got to figure that out. So hopefully I'll know more by tomorrow. Thank you. Yeah. Any other questions I can dodge, or statements of wrath and fury, or I don't know.
I have a question.
Okay.
I have a question.
Yeah.
For the quiz and the access, the access quiz is kind of like homework, but the quiz that comes right after the access quiz, are we able to use our notes on those, just not
Yeah.
the exam?
Yes.
Okay.
Yeah,
Thanks.
even within the quiz, you can see that it gives you access to the ebook, stuff like that. So that the quiz is open book, open note, just not open neighbor. So maybe that brings up another thing that I think might be worth looking at real quick. Because the way I feel like the structure of this course, as I began to understand it more, is pretty complex. Like they've got a lot of little things going on in there, tons of these different little assignments. And so so by telling all of you this, so this is in the syllabus where I'm at right here. I'm not telling you to not do any portion of your homework, okay? Just do all of it, and that'll be the best thing for your grade. Okay. But by way of recognition of how the grades are weighted, recognize that you need to put, the most effort into certain areas. So first of all, like this homework support that's worth 10% of your grade, that is those presentations that you signed up for. So if you don't do those, if you blow off both of those and get zeros on them, then like the best score you could possibly achieve in the course is a 90%. So and there's only 2 of them. So they're each worth 5% of your grade. And I don't know how other people grade them, but honestly, if you give a good effort and put together a presentation, you get all the points. So to me, that's like an easy 10%, right? You just do it. And recognize that the quizzes are 15% of your grade, but the quiz access assignments are actually worth 0%. So it's structured that these are ungraded assignments, really just to prepare you to do well on the quiz, and then the quiz is worth a substantial portion of your grade. I don't think a lot of people recognize that. So like, I'll have people panicking that the quiz was weird and it took a point off, but I still had enough 90% to get to the quiz access was being weird, but I still had enough to get to the quiz. So recognize if you get a 90% on the quiz access or 100%, that doesn't change your grade at all. It's the quiz score that ultimately is the most impact on your grade. So I hope that doesn't make anybody mad. That's just how the course is set up. And then like these little concept video and smart book assignments and the financial analysis and Excel activities, those are only 5% each. So they're relatively small. So again, I'm not saying don't do them. I'm saying if you ever had a week where you were stretched to the limit and something had to give, get that quiz access and quiz done, and miss the concept video or something if you were really pressed for time. And then exams are, the lion's share, 55% of the grade. And so that weight is right there for you to see in the syllabus, but I think a lot of people miss it. And so, I've found, especially if there's any of you that are moving on to like a master's degree, like the first thing you got to do in master's courses is like look at how the grades are broken down, and then like just adjust your time accordingly, because sometimes you are stretched thin and you have to sort of pick and choose. Anyway, so I just wanted to make that announcement as a general announcement as well before we get into more specific accounting stuff. Any other questions? Or
I have one other quick question since you brought up the quizzes, and I don't know if I just missed it in the syllabus, but one of my quizzes, it says that the assignments dropped and it won't be considered in the total. It's not the quiz access, it's the actual quiz. Did I miss that there's like we dropped the lowest quiz grade or lowest 2 quiz grade somewhere?
Let's Good question. Let's see if it has that in here.
I have the same thing in my grades.
So the grade book is showing that like it's dropped.
Yeah.
Mine
like-
did that for 1, 2. I think it's
Okay.
the one that was initially listed in week 2, but then got bumped to week 3, and now it just says it's not going to be counted.
That's the one
Well-
that is for me also.
Well, is it a quiz or is it the
It's the actual quiz. It's the
Okay.
chapter 1 and 12
So-
quiz.
So I know they, in previous versions of this course, they had it drop your lowest quiz. So if you've only taken one, even if you got 100%, that's your lowest quiz. Does that make sense? So if you take another one and get a 50% on it, it'll automatically select that one and drop that as the lowest quiz. I don't see that
It did
says
do
that anywhere in the syllabus. But I'd say if the course designers left it set up that way, then I might just keep my mouth shut on that one so that it can drop your lowest quiz in case you ever have a bad one.
So mine was like that too, Brother Fox, but today when I checked, it now shows that it scored me.
Interesting.
It
But
did-
did you take the next quiz?
Yeah, I did.
Did you score less on it than on the first
No,
one?
they're both 100% and they're both showing up. So
Okay. So that's another question I can ask the course designers and see if that's, was that on accident? Was that on purpose? What is the deal with quiz grades? So let me write that in my notes to ask. Drop lowest. Because believe it or not, as an instructor to this course, I got access to it about, I think you guys had access on Saturday and I had access to it, I think on Thursday. So 2 days before you. And so there's lots of little quirks I'm still recognizing myself. And I will say though, that this course council process they're doing has been really responsive, and we have an issue, we reach out, they deal with it. But I kind of wish we would maybe done this as a dry run before there were students in it, instead of making this so stressful on you guys. So I apologize for, whatever pain you've suffered, that could have been avoided. I'm sorry for. Anyway, so I will try to get an answer to that question as well. So now I've got 2 on my list: the Proctorio issue and the quiz grades about dropping the lowest. Any other questions I can say I don't know the answer to and add to my list? I'll try if I know the answer. All right, well, that's good. So hearing no others, there's kind of I think I have a little bit of a lengthy presentation. I hope it's not too much today, but chapter 2 really gets to like the meat of like the basics of accounting. I really wish we had done this before pushing you into chapter 11, especially because in the chapter 11 work, they had like journal entries for you to do, but we've never gone over the concept of journal entries. So I thought that was a strange thing that I also have made mention to the course council. I think I gently said something like, there's a reason every modern accounting textbook introduces things like equity and cash flow at the very end of the text, not at the beginning, because they're complex concepts. But so we'll see what happens there. So let's see. I'm going to actually swap that. Oh, I'm way down at the end of this thing. I told you it's long. All right. Okay, so here we go. Again, this is for lack of a better term, a lecture. But please, if you have questions, like, do not hesitate to interrupt. Like, don't, and I mean, you can do it in the chat if you don't feel comfortable just breaking in over the top of me. But if you're looking for a clarifying question, I will not be offended if you just say, hey, what's this or what's that. So, but as much as I hate PowerPoint, I don't know a better way to cover a bunch of information in a relatively short amount of time. So, all right, so we're studying accounting, and the reason it's called accounting is because it has accounts, okay? And so an account is just a record of an increase or a decrease of a specific type of either an asset, a liability, an equity, a revenue, or an expense. And I would put they don't have it on there, but I would also add, why am I drawing a blank on the term? When your stock pays out a portion to the owners, dividends. So they're included as a type of account as well. And then the general ledger is a record of all the accounts that we use by the company. So these are just definitional terms that you'll kind of need as we go forward. So the first type of account, and this will be a review, I think we touched on it already in chapter 1, are asset accounts. And just remember that an asset is in essence something that a company or a business or an individual can own. The most common assets are cash, land, buildings, equipment, supplies, all those sorts of things. And probably the ones that are a little more confusing are the ones over here. So the accounts receivable, notes receivable, and prepaid accounts. Accounts receivable is money that's owed to you by your customers. It usually arises from sort of a informal relationship. So when I say to a customer, hey, you have 30 days to pay me, as soon as I deliver the goods to them and they owe me money, that creates an asset for me called accounts receivable. Notes receivable is similar. Someone owes you money, but instead of it being informal, it's more like written up with terms like who's going to pay whom and how much and what the interest rate's going to be and what date everything's due. And so just the difference between accounts receivable is it's usually short-term and informal, and notes receivable is usually long-term and more formal. And finally, a prepaid account. This is an asset that arises when we prepay for some good or service in the future. So for example, I own a rental storage business. And when people pay me in advance, so let's say they pay me for a whole year's rent, that creates an asset for them called prepaid rent. Now they either have the use of my facility for the next year because they've already paid for it, or I would need to give them their money back. So just common things that we prepay are rent, insurance. A lot of people pay for their car insurance 6 months at a time, and so they're prepaying for it. So those are the asset accounts. Liabilities are debts that a business owes. So accounts payable, notes payable, what are called accrued liabilities and unearned revenues. So accounts payable are kind of the opposite of accounts receivable. So accounts payable are when I buy something from a supplier and they tell me I can pay them in 30 days. I owe them money. And so that's an account payable. And a note payable is when I owe somebody money on a more formal, drawn up note that has terms of payment on it. So when we buy a building, we're going to do a mortgage, which is a form of note payable, or when we buy a car or a piece of equipment. Unearned revenue is money that I have received in advance. So kind of my example with my storage building a minute ago, when the customer pays me in advance, to the customer, that's a prepaid asset. They have the right to the rent for the next year or 6 months, whatever they paid for. To me, the business, when someone pays me in advance, I have what's called an unearned revenue. My money went up, my cash account went up, but I haven't yet delivered the goods or services. I'm going to do that over the next year. So in the meantime, I owe them. I owe the customer who paid me in advance those services. And then accrued liabilities are those debts that sort of arise just as in our normal course of business. The most common ones would be something like, as my employees work, I owe them for the hours they work, but I don't usually pay them until payday. So I have this accrued liability of payroll up until I actually pay them. Tia, I see you have a question. I can't hear you. Are you muted maybe, or?
Can you hear me?
Yes, now I hear you.
Okay. I'm just concerned or wondering about the unearned revenue. If monthly, does that then go down because you are delivering on that goods if they prepay for 6 months or a year?
Absolutely, yeah. So what we do is at the end of each month, we do what's called an adjusting entry to recognize that we've earned a portion of that revenue, and then our liability is dropping each month until we've earned it all. You're ahead a whole chapter, Tia, so good. That's adjusting entries come later. They're the bane of everyone's existence for a little while. But Equity accounts. So equity is a little weird because equity represents the amount of the business that the owners have claim upon, that the owners actually own. If you think about it, the fundamental accounting equation that we learned, assets equal liabilities plus stockholder equity, that means that assets minus liabilities equal equity. So what the business owns minus any debts is what's left over for the owners, and that's the equity. And so equity comes in one of two ways. We either buy it by putting money into the business, that's called common stock, or the business earns it. And so that's why revenues will increase our equity, but expenses and dividends will decrease our equity. The difference between revenues, expenses, and dividends is what's called retained earnings. That's earnings that the business has made that it has not paid out in the form of either expenses or dividends, which is just paying out a share of those profits to the owners. So those are our account types right there. If you know that, you know a lot more about accounting than most people anywhere. So good job. See, you already know a bunch. All right, so there's our accounting equation, assets equal liabilities plus equity. And then equity is further broken down into common stock minus dividends plus revenues minus expenses. So that just shows it all as a single sort of picture. They call them exhibits. And this is in the book too. So if you wanted to look at it again, it just sort of summarizes everything there together. All right, so now we're into debits and credits and double entry accounting. So I think people often get sort of flustered by the concept of debits and credits because we've all grown up, not all of us, but most of us have grown up with banking. And so we've had bank accounts and we think, okay, so a debit is we tend to think of a debit as a bad thing because it's money coming out of our account, and a credit as a good thing because it's money going into our account. So we almost like place these predicates of value on the terms debit and credit. And what we have to do is sort of forget that and just say that all that debit means in an accounting sense is that an entry that occurs on the left side of a T account. And all that credit means is an entry that occurs on the right side of a T account. What I have on the screen here is a T account. So you have the name of the title, and then these lines that kind of look like a big broad T. Debit entries occur on the left, credit entries occur on the right. The reason we can't put a value to it is that some accounts will increase with a debit entry and others will decrease with a debit entry. So it doesn't necessarily mean good or bad or increase or decrease. It just means left or right. Think of it like port and starboard, right? It's just left and right. They're directional terms, not terms of value or other meaning. So the reason we call double entry accounting is because every time we make a transaction, we have to have debit entries and credit entries, and they have to balance. So the debits have to equal the credits. So we can see here that assets are increased with a debit and decreased with a credit. But liabilities and equity are the opposite. So liabilities and equity are increased with a credit and decreased with a debit. You'll see on here, some of these sides are labeled the normal side, okay? All that means is we would expect accounts to have a balance that is on the positive side, the side that increases that account. So assets, normal balance is on the debit side. Liabilities and equity accounts, normal balance is on the credit side. When people say, is there a magic to memorizing this? And the answer is sort of, like you just have to memorize it. For me though, since I know that assets are the opposite of liabilities and equity because they're on the opposite side of an equal sign. If I can remember that assets increase with a debit and decrease with a credit, I can remember liabilities and equity are the opposite. So I like memorize one and get all three. That's how my brain works, but that may not work for you. So let me show you, and also let me show you an expanded view of this that includes these other accounts. So there's our assets, increase with a debit, decrease with a credit, have a normal balance on the debit side. Liabilities, increase with a credit, decrease with a debit, normal balance on the credit side. So now when we have these equity accounts, we have to remember that the ones that increase equity, so common stock and revenues, they're going to behave like equity accounts behave, where they increase on the credit and decrease on the debit. But the ones that decrease equity, dividends and expenses, they're going to behave the opposite of those. So if this seems like a lot, don't worry. I'm going to try to take you through several. That's part of why this slideshow is kind of long, is I'm going to take you through several examples of debit credit journal entries to show you how it works and talk through the process of it. So really at some point you just have to memorize this and then build that into a working relationship with these rules of debits and credits. So to find the balance of a T account, so recognize that this is our cash account, and you'll see it has debits of 30,000, 4,200, 1,900, and all of these credits over here. In order to find the balance of the account, what we do is we add up both sides. So this has a total of 36,100 on the debit side and a total of 31,300 on the credit side. Then we subtract the smaller side from the larger side, leaving a balance on that larger side of 4,800. And so if I was talking accountant talk to you, I would say our cash account has a debit balance of 4,800. That's another way of saying our cash account is a positive 4,800. We don't have negative cash, right? We have 4,800 in our cash account. So that's the process for finding the balance of an account. Okay, so this looks really overwhelming with all these red arrows going all over the place. But this is just what a journal entry looks like. You've actually already been, I guess, exposed to journal entries because you had to do some of them in the Chapter 11 work. So journal entries are always written with the debit entry first and the credit entry second. Sometimes there's a note down here. And so what helps me is to sort of go through and translate what's happening in an entry. So we see A is the transaction date, B is the title of the account in the debit column and the amount of it. And then C is the title of the account and the credit and the amount. Then D is an explanation of the transaction. So even if I didn't have this explanation, I would look at this and say, okay, cash was debited, which means, and it was an asset account, which means it increased then by 30,000. And common stock was credited. It's an equity account, which means that the credit is an increase by 30,000. So what must have happened here is some owners put $30,000 into the company in exchange for stock in the company. On the second one, I have supplies being debited and cash being credited. So I would go through this process of saying supplies are assets. And so a debit entry to supplies would mean supplies increased by 2,500. Cash is an asset, and a credit to an asset account means it decreased. So someone must have purchased supplies for cash. In other words, it helps my brain to sort of translate a journal entry into standard English, if that makes any sense. So sometimes instead of a T account, you'll see something that looks like this. This is a balance column account. It actually shows the same information as the T account, but it's a little confusing the first time you see it. Just has a date, if there's any explanation for the transaction, which these ones don't have one. And then it shows that the cash account was debited 30,000, and then it carries the balance over to this final column. Then on December 2nd, it was credited 2,500. So the new balance of that account is 27,500, or 30,000 minus the 2,500. Then on the 3rd, it was credited another 26,000, and a new balance is calculated. Then on the 10th, it was debited 4,200, and a new balance is calculated. This balance column, since it doesn't have a debit and a credit side, is always going to be assumed to be the balance on the normal side. So because cash is an asset, we're saying this has a cash account has a debit balance of 5,700 at the end of this period of transactions. All right, so let's get into some examples. I think that will help the most. All right, so the book here highlights a 4-step process for processing transactions. Number 1 is to identify the transactions. Number 2 is to analyze the transaction using the accounting equation. Analyze means ask yourself what accounts are impacted and what's happening with them. And then we record the journal entry, and then we post the entry to the ledger. And by ledger, I mean this balance column account or the T account. The ledger is the part of the account where we get to keep track of the overall balance of each account. So recognize that these journal entries we do chronologically. Each time a transaction happens, we do a journal entry for it. And then we post it to what's called the ledger, which I'll show you in the examples, to find the balances of the accounts. All right, so here's our first transaction. Fast Forward, it's the name of the company, receives $30,000 cash from Chaz or Chase or something. We'll call him Chaz. It sounds pretty hip. Chaz Taylor in exchange for common stock. So what I have to do is analyze and say, okay, what's happening here? Cash is going up, and cash is an asset, and common stock is going up, and common stock is an equity. And then it says record. What I would say is apply the rules as I've learned them. And so since cash is going up and it's an asset, that's going to be a debit to cash. And since common stock is going up and that's an equity account, that's going to be a credit to common stock. So there's my journal entry: debit cash, credit common stock. And then step 4 is I post it to the ledger, which is, in this case, they're using T accounts just to show us the balance of each of those accounts. So there's the first transaction. Second transaction, we purchase supplies for cash. So again, what's happening? My cash is going down and my supplies is going up. So supplies is an asset and it's increasing, so I'll debit supplies. And cash is an asset and it's decreasing, so I'll credit cash. Then I will post those over to their T accounts. We can see now that supplies, which didn't have any balance, now has a debit balance of $2,500. Cash, we'd already made one entry on the debit side. If we were to calculate it right now, we would say this account has a debit balance of $27,500 because that is a debit of $30,000 and a credit of $2,500. But we usually don't do those, tally them up until we're done making all of our entries. All right, transaction number 3, they purchase equipment for cash. So now I have equipment going up, cash going down. Equipment is an asset, so I'm going to debit it to increase that account. And cash is an asset, so I'm going to credit it to decrease that account. And then I'll post those over to my ledger or to my T accounts. Transaction 4, we purchase supplies on credit. Whenever it says on credit, that's a secret accounting word, meaning we don't pay cash, okay? That we're going to be creating a payable account. Also, anytime you see payable in an account name, that's a secret accounting word that means it's a liability, okay? So in this case, I have supplies, an asset increasing, that'll be my debit, and then accounts payable, a liability also increasing. Right, this is confusing because sometimes people think, is that increasing or decreasing? So it's increasing because accounts payable, we owe more. We have more debt now than we had before the transaction. So our liability increases with a credit. So there's our entry: debit supplies, credit accounts payable, and then post it over to our ledger. Provide services for cash. So when we earn money by doing services, we call that revenue. And so here we have our cash increasing, and that's an asset, so we'll debit cash. And we have a revenue increasing, and revenue is an equity account. And so we increase that with a credit. When we pay expenses in cash, we have our cash going down and our expense going up. And so remember that expenses are equity accounts, but they reduce equity. So expenses, when they increase, we record them on the debit side. So we're going to debit rent expense and decrease or credit cash. So you should recognize by now that every time we do a journal entry, the debits and credits balance, meaning we have the same amount of money being debited and credited. Also recognize that this one right here is a very common transaction. Think about how businesses run. You're going to be debiting expenses and crediting cash all the time. That's just a normal thing. In your own personal bank accounts, you do a lot of buying things for cash, right? So if you were recording that, it would be a debit to the expense account and a credit to the cash account. Which leads us to the question of, why do banks say that it's a credit when money gets added to your account? If each time we deal with a credit here, it's the asset going down. And the answer is because they're speaking from their own standpoint. So anytime you put money into your bank account, what you're technically doing is you're loaning the bank your money. And they owe that money back to you on demand whenever you call for it, if it's in a checking account. And so that's why they call it a credit, because they're crediting their liability account, probably called something like customer deposits or something like that. So recognize that that's what's happening, and that's why we're all sometimes backward on the whole concept of credit and debit. All right, transaction 7, we pay an expense in cash. So we pay our salaries of $700. Again, our expenses are going up, so that's going to be a debit. And our cash is going down. That's an asset, so that's going to be a credit to cash. Provide consulting and rental services on credit. So now it looks like, let's see, we provide consulting services of $1,600, and we rent our facilities for $300. The customers bill $1,900 for the services. So since we're doing it on credit, it means the customer is not paying us in cash. Instead, our asset accounts receivable, money owed to us from the customer, is increasing. And so we debit accounts receivable for $1,900, and then we credit consulting revenue and credit for $1,600 and rental revenue for $300. This kind of entry right here, I think it's the first one we've seen, is called a compound entry, because it has more than just one debit and one credit. This one happens to have one debit and two credit entries, but both sides still balance, right? So we still have $1,900 in total debits and credits. Receipt of cash from accounts receivable. So this is where our customer now pays us for the money they owed us. And so in this case, we have cash going up, an asset increasing is done with a debit, and accounts receivable, an asset decreasing, and that's a credit. So you'll see over here on our balances, we're starting to get quite a few transactions piled up in our cash account. Our accounts receivable just had the debit of $1,900 from entry number 8, and now the credit of $1,900 from entry 9. And so accounts receivable at this point has a balance of 0, right? We're not owed any more money. And so that happens a lot. Customer owes you money, then you collect it. That's normal business. I told you there was a bunch of examples. So here we get a partial payment of accounts payable. So here's someone, we owe money to someone, but we're not going to pay them everything we owe. We're just going to make a payment on it. So we pay Caltech Supply $900 cash toward the payable from transaction 4. So we're going to have our accounts payable, that's a liability account, going down because we're paying off some of that debt. So liabilities decrease with a debit. And then we're going to have cash going down, that's an asset, and it will decrease with a credit. So our journal entry would be to debit accounts payable, credit cash. A few more here, we're almost done. We pay a cash dividend. Remember, a dividend is paying a share of our earnings out to the owners. So when we pay a cash dividend, our cash goes down and our dividends go up. So dividends increase with a debit, and then cash decreases with a credit. Here we receive some cash for future services. So it says we receive $3,000 in advance of providing consulting services to a customer. So our cash will go up, but we haven't earned it yet, so we can't record it as revenue. Instead, we'll list it as an unearned revenue, meaning we received money in advance of doing the work. So that's a liability, right? We owe the customers that service. So we'll debit cash to increase the cash, and then we'll credit the liability unearned consulting revenue to show that we owe that money or owe that service to the customer. And then paying cash for future insurance coverage. So we pay $2,400 for a 24-month insurance policy. So again, our cash will go down because we're paying out cash. And then our prepaid insurance, which is an asset, will go up. So we'll debit prepaid insurance and credit cash. All right. Oh, there's another one. I thought there was only 13. That'd be bad luck. So here we go. We purchase supplies for cash. We pay $120 for supplies. So again, our cash goes down, our supplies go up. They're both assets. So we debit supplies and credit cash. Oh, there's even more. Believe it or not, I made these slides today, so I should know how many. I just, my brain sometimes it has these moments more and more. So here we pay expenses for cash. Again, our expense is going to be debited and our cash account will be credited. Another expense for cash, we have salaries being debited, cash credited. So recognize this pattern. Every time we pay an expense in cash, which is a very common transaction, we're going to debit the expense account and credit the cash account. All right. So here's a summary now of our ledger. Remember the journal entries that we were just looking at are chronological entries. Each time a transaction occurs, we create one of these journal entries with a debit and a credit of the appropriate accounts. Then we record it over or post it to the ledger. And then at the end of the period, we have this ledger and we can find balances by adding up both sides, subtracting the smaller side from the larger side to find a balance for the account. So here we can see our assets. Cash has a balance of $4,275, accounts receivable 0, supplies $9,720, prepaid insurance, equipment, our liabilities, our accounts payable and our unearned revenue, and our equity, common stock, dividends, consulting revenue, rent revenue, and then expenses. Again, you'll notice that the common stock and the revenue accounts have balances on the credit side, because that's the side that increases those equities. And then these accounts that reduce our equity, dividends, and expenses will have balances on the debit side. All right, so once we have that, so what we do, even in real life, okay, is we do these journal entries throughout the month, and then at the end of the month, we tally up our ledger to find the balances, and then we create something called a trial balance. And a trial balance just shows all of our accounts and then the balance of each account. And you'll notice that the debits, which will be our asset accounts, our dividends, and our expense accounts, should equal our credits, which will be our liability and equity accounts and our revenue accounts. So that's a trial balance. If your trial balance doesn't balance, then something's off. So it's kind of nice. It's a self-check. It kind of stinks when it happens though, because you'd really like to be done with it. Usually by the time you get all of those journal entries posted to the ledger, find the balances of the ledgers, and then put it in here. If it doesn't balance, it's a little frustrating at times. Anyway, so once we have the trial balance, we are prepared to calculate or create our financial statements. Again, the financial statements were introduced to you before, but now we are ready to create them. So the first one we'll create is called the income statement. And the income statement summarizes our revenues and expenses. So you can see here that we had revenues from consulting, from rent. So our total revenue was $6,100. And then we had expenses, salaries, rent, utilities. So our revenues minus our expenses is our net income. So that's the income statement. You'll notice dividends isn't on here. Neither are any of the other accounts like assets, liabilities, or common stock or dividends. So The next thing is what's called a statement of retained earnings down here at the bottom. So there's still the income statement up top, and then now we've added the statement of retained earnings down at the bottom. And you can see the retained earnings statement works this way. It starts with what our retained earnings were at the beginning of the period. So the retained earnings were 0. It's a brand new company. There were no earnings for them to retain. Then we add the net income, which we calculated up here on the income statement, which is revenue minus expenses. We subtract out any dividends, and then that gives us our retained earnings at the end of the period. So retained earnings is really just the net income or profit the company earns minus any dividends that it pays out. And then we're ready to prepare our balance sheet. So our balance sheet summarizes our assets, our liabilities, and our equity. And we know that our assets have to equal our liabilities plus our equity. That's the basic fundamental accounting rule. So it has our assets, cash, supplies, prepaid insurance, and equipment. Then our liabilities, accounts payable, and then unearned consulting revenue. And then our equity, our common stock, and our retained earnings. So recognize that we pulled retained earnings off of the statement of retained earnings. And in order to calculate our retained earnings, we had to have net income, which we pulled off of our income statement. So we have to create them in that order: income statement, then the statement of retained earnings, then the balance sheet. The good news is in real life accounting, pretty much I just enter my journal entries throughout the month, and then at the end of the month, I click run reports, and it does all that for me. But if you're going to be in business, then you have to understand the process, right, that your software is using to do all of that. And so that's what we're learning here, is all of these accounting processes, even though many of them are done by computer now. All right, a couple more concepts, and then we're done. The first is how to calculate what's called the debt ratio. Your debt ratio is your total liabilities divided by your total assets. So this helps us understand if our debt is at a risky level or if it's at an okay level, okay? So it's just comparing our liabilities to our assets. So if we had $10,000 worth of liabilities and $10,000 worth of assets, our debt ratio would be 1, right? That they'd be 10,000 divided by 10,000 would be 1. So think of it in terms of if liabilities climb relative to our assets. So if liabilities were 20,000 and assets were 10,000, then our debt ratio would be 2. So generally speaking, having a higher debt ratio is considered a negative thing because it means you have more debt relative to your assets. So here's an example of it. We have Costco versus Walmart. So they give us Costco's total liabilities. I'm guessing that's in millions. When it says in millions, it means we're going to add 6 zeros to that number. Okay. If it says in thousands, we would add 3 zeros. If it said in billions, we would add 9 zeros. Okay. You know, so Walmart, for example, has assets, you know, not in the millions, but in the billions. Just go into one Walmart store and think about what the value of that inventory is in that store, and then multiply that by the 1,900 stores they have, and then all the warehouses, right? Anyway, so they find the debt ratio by taking the total liabilities divided by the total assets, and we can compare these, and we can say, even though Walmart's a much bigger company, it would be hard to just look at the absolute dollar numbers of Walmart compared to Costco. This brings us down into a common level, and we can see that Walmart's carrying less debt relative to their assets. And that's what we use that for. Okay, that's it from a presentation standpoint. And so now, and I am running short on time. I have another class coming in in about 5 minutes, but they're taking an exam. So if we need to, I can get them started on that and then still try to answer some of your questions. So I guess my question is, are there any questions? That was a lot of material. I recognize that. So either I explained it really, really well, or you're in stunned silence, one or the other, or I don't, stupor of thought. I don't know. was like me taking calculus in college and just being like, somehow I got a B, but I still don't understand any of this. That's how I felt about calculus. Well, good. I mean, if there's no questions, then we can finish up and close out the meeting. So I guess one last chance for parting comments or questions, and then we can say a prayer.
Brother Fox.
Yes.
I had a question on the quiz, but we can't really talk about it right now, probably because people are still taking the quiz.
Okay.
And it was number 7. I noticed you did in the study content, but that was from the access quiz. So it's a different number 7, but it's the shareholders equity report. Somehow I ended up figuring it out, but I have no idea why.
Okay.
But maybe we can talk about that or do a video on it or something, but
Yeah, I can.
yeah, it
I
was
can
number
pull that up and
7
take a look at it, and I'll
Yeah.
send you an email.
on the actual
to Judy.
quiz. Yeah. Shareholders equity report. It was kind of confusing. And I know it's probably way ahead of what we're still going to learn, probably how to do it, but.
Well, and that's actually like the chapter, if you think about it, that's the chapter 11 stuff.
Yeah,
right?
exactly. So I thought
so-
maybe it'll start to make sense over the next few weeks. And
Yeah. Yeah. And, and here I'm jumping to chapter 2. That's why I like to do this on Thursday, because then that's exactly what you're working on at that point. But
right.
so, yeah, so let me take a look at it, and I'll send you an email and
Thank
see.
you.
Okay.
Judy, I was actually the same way. I somehow got it right. I don't know, Brother Fox, if we could give, I mean, obviously a lot of people are going to run into that problem. And in the access quiz, I don't think we had one exactly like that. It was quite a bit, this one was quite a bit more complicated than what we had in the access quiz. I don't know if it would be okay. I can give a couple small hints to just help with that. I don't know if just emailing 1 or 2 of us would be beneficial, because that obviously needs to get done. And if we don't understand it, that's hard.
Yeah, I'll say this though, so the intent of a quiz, as opposed to an assignment, is to measure your learning, right? And so apparently you were able to work through it. Now, that doesn't mean you fully understood it, but it means you had something in your learning process prepared you to successfully complete it. And that's what I think they're trying to measure. So it may be a disservice to people to give them too much, to not allow them to have to work through that. I know that sounds maybe cruel or something, but it's kind of like when you watch your kids struggle with something and you're like, do I just stand back and let them work through this? Or do I step in? And so that's why I thought it may be more helpful for me to reach out and actually talk to Judy, who's already done it, because now that she's been able to work through it, it wouldn't hurt at all to say, well, this is how you got it, or this is why it's this way, as opposed to, for lack of a better term, spoiling that. Sounds like spoiling a surprise. It's fun, but for people who there's value in them working through it.
Definitely makes sense. It's definitely not a problem that I super got out of the book or the context of how it was. It was very much more involved than what was in our book or on the access quiz. So no, I definitely get that, but I would love, if you look at it, if you could kind of walk me through that as well, since I mean, I got it.
Right. Okay.
Not 100% sure how I fully understood it, but
yeah, maybe
that would be beneficial.
You could post a video about it in the study content after tomorrow, like maybe Thursday, Friday, or Saturday. Then we could take a look and just for our own knowledge, understand it, because the quiz will be over by then.
Right. Yeah.
That's a great idea.
Yeah. Okay. Okay. Well, I better finish up then. So Judy offered the opening prayer, so we can't make her say the second one, because double blessings is just something we try to avoid at all costs. It's like if I asked one of my kids to say the closing prayer when I'd ask them to say an opening prayer, I'd get like dark looks. And so apparently they don't want double blessing. And anybody other than Judy, and I don't think she'd give me a dark look, but anybody other than Judy who'd be willing to offer a closing prayer for us?
I can do it as long as my kids stay quiet in here.
Okay. So nobody will get mad if they make kid noises while you're praying.
Okay. Our kind of gracious Heavenly Father, we're thankful for the opportunity that we had to meet with Brother Fox this evening to learn a little bit more about our class and to better understand the concepts that we're reading about and we are trying to understand. We are grateful for his willingness to provide his time and to meet with us. We're grateful for the things that we're learning in this class, that we're able to extend our knowledge and to be able to grow in our knowledge and in our experience in our daily lives. And we ask you to please bless us as we depart, that we'll be able to have a good evening with our families and in our tasks. We say these things in the name of thy son, Jesus Christ. Amen.
Amen. Thank you very much. Everybody have a great night.
Thank you.